Good afternoon. My colleagues and I remain focused on keeping consumers informed on the latest industry news to aid their decisions to borrow, buy, and build real estate. As you understand, the Fed has left the benchmark rate unchanged for the seventh consecutive meeting. Therefore, Fed funds stands at 5.5%, making the prime rate 8.5%, with the next scheduled FOMC meeting date set for 30 and 31 July. In contrary to popular belief, the benchmark rate set by the Fed does not directly control mortgage rates. However, Fed actions can influence the mortgage market through short-term monetary policy and setting market expectations. Bond markets, mortgage-backed securities, inflation data, employment data, and investor appetite will interplay to determine mortgage rates daily, leading to fluctuations observed by borrowers and lenders alike. By and large, the range for the 30-year fixed-rate mortgage traded from 7.5 to 7% over the last 45 days, while rates trending lower from last month to this month and the last FOMC meeting. Today, Jerome Powell emphasized that it would not be appropriate to lower the target range until there's further progress towards the 2% inflation target. Economic activity remains strong, as indicated by a strong labor market and low unemployment. And despite cooler energy costs, inflation remains elevated, but showing moderate progress towards the 2% inflation objective recently. Moreover, the Fed announced its slowdown in the reduction of holdings for U.S. Treasuries. Starting in June, the monthly redemption cap for Treasuries will be reduced from $60 billion to $25 billion, but the outlook for agency debt and mortgage backs remains at $35 billion. Now, the decision to hold rates reflects the Fed's challenge to balance economic expansion while keeping inflation under control. Elevated rates have not stopped consumers from spending or businesses from hiring. The labor market continues to add new jobs, with May's data showing employers adding 272,000 new workers. Job openings also remain higher than typical pre-pandemic levels, with 1.2 jobs per worker. And while unemployment remains near historic lows, it did tick up to 4% last month, but the latest CPI print shows core prices from the same time last year climbed to 3.4%, reflecting the lowest read since 2021. All of this new information gives the Fed confidence they're moving in the right direction, just not the machismo to lower rates at this time. The outlook for 24 initially included 3 rate cuts, but have updated their plans to include just 1. The mortgage market rallied on the lower than expected CPI figures, but the gains were dialed back post-meeting based on the rhetoric of the number of cuts. Lenders that did not reprice for the worsening today may do so in the morning. And with that, I take your questions.
Chief Matty, Paul Lynch with the National Enquirer. I must ask you a question. Case Shiller reported a white-hot read on the year-over-year home price appreciation for more than 7%. And while you claim to be making progress, are you doing enough to combat the rising cost of housing?
Thank you for your question, Paul. The housing market remains a tough sitch. Higher mortgage rates do curb home affordability, but what we're witnessing in real time is that affordability is shrinking based on the availability of homes. The limited inventory is keeping prices of available homes up month over month and year over year. Now, it's right, one would assume that as rates are driven higher, that home prices would fall, but that's not the case. And we've had longer runs on housing shortages and elevated demand before the pandemic. But many of the homeowners today are sitting on super low rates and simply can't afford to move. So that's compounding the inventory problem. The limited supply is pushing up the prices of existing homes and new homes alike. We see this longer-term problem of not enough homes built will remain a long-term problem. But inventory will increase as interest rates moderate and normalize. And I trust that that answers your question. Go ahead.
Chief Matty, it's Bob Lotta from the Babylon Bee. We've heard all year that the Fed will cut rates. First we heard 3, and now it's 1.
Why do you keep moving the goalposts?
Well, awesome analysis, Bob. But we can agree to disagree that the Fed has been very fair with their next steps. And although those steps are baby steps, it's based on the data. And as you can see from the latest CPI number, that inflation has yet to abate to the levels where they can trust cuts will do the job while not making the job harder. And yes, it's not ideal, but I know that you know that at the beginning of the year, there was about 3.6 annual inflation. And as of this morning, we're at 3.4, which is just a tad bit below, but shows that they're making progress. But as mom always told me, good things come to those who wait. And when they hit checkpoint Charlie, you'll know, we'll all know, and we won't have to wonder. And I understand seeing is believing, but rates will come at the appropriate time. So, next question, please.
Oh, hi, Karen Canet from The Onion. Chair Batty, we've seen housing only serve the wealthiest Americans. For those that can afford to either pay cash or afford these high home prices. It's the highest rates it's been since the 2000s. Certainly, there's more the Fed can do to help or assist lower-income families.
Karen, the Fed has a toolbox. You know, it's about yay high and about ye wide. Would you like to know what's in it? Oh, you do? Okay. Well, they can buy or sell mortgage-backed securities. They can even collaborate or advocate with government agencies to promote the construction of more housing. Also, they can coordinate with other regulatory policies to restrict or expand lending standards. That's a YP, not an MP. However, they can't create housing programs. That's the responsibility of banks and lenders. But the good news is, I do know of a bank that's doing a wonderful job at this, and they've committed $88 billion over the next 18 months in loans, grants, and other financial support to bolster housing opportunity for just those communities. And last year, they invested over $13 billion in home lending alone. They've got some great programs with a variety of down payment options to help people stay and buy homes. And I encourage you to check out PNC Bank and the PNC Community Benefits Plan for more details. They've got grants, tools to help middle and lower class families break into housing. So check that out.
Yes,
Chairman,
it's Jim Harbaugh from the Villanova. I mustache. You a question? Mortgage applications picked up from the last 2 weeks, both on the purchase and refinance side. We're hearing from real estate investors in the community that inventory is picking up. Is this good or bad?
Jim, you're right. As I mentioned in the opening, rates over the past month are trending down. With the weekly average of the 30-year fixed at 7.02%, somewhere in that range, and mortgage rates through last week were heading lower until we had that payrolls number that came in way above expectation. And obviously, refinance applications are sensitive to interest rates, and we should see that number bounce around. And I agree, multiple sources have declared an increase in inventory, which should be welcome news, by the way, to home buyers as they've been turned off by limited options. I mean, how much fun can you have viewing one home? You got to read it, not write it. And as inventory is near historic lows, it'll remain so for an extended period of time because it's a long-term problem, right?
Hi, Chair Batty. It's Walter Sobchak from the Low 5 times. How can you explain how mortgage rates are improving over the last month without the Fed changing rates, whereas declared today not purchasing more mortgages?
Well, thank you, Walter. I remember mortgage rates, they don't need to wait for the Fed to improve. Mortgage rates will react to slower economic news or signs of a recession. If investors anticipate slower times ahead and expect the Fed to lower rates in the future, that expectation alone can lower long-term rates for mortgages. And as investors seek safer haven investments like bonds, that alone will drive down yields. With more investors attracted to treasuries and the like, it pushes prices up and yields down. Remember how price and yield move inversely. See, mortgage rates are often linked to the long end of the yield curve, and day-to-day changes in mortgage rates will depend on inflation trends. And as you see with the latest CPI print, inflation is trending in the direction we want, more towards a neutral market, and as time, rates will decline. Okay, over there. Yep.
Hey, Chair Matty, Gary Grice with the Woo Chronicles. We've heard from both Chair Powell and Secretary Yellen comment on the use of negative interest rates by other economies. Both have said that they've given consideration negative interest rates in the past. Do you think that's a real possibility?
All right, I get this question every meeting. Not only do I think it's possible, I think it's more than likely. We've seen central banks, mainly Japan, but also the European Central Bank, and even the Swiss bank implement negative rates to combat low inflation to light a fire under a weak economy. And these policies have mixed results, with the benefit of lowering borrowing costs to spur spending, but there's the offset of bank profitability and returns for investments and savings. You've got nothing to worry about now, but it's coming. You got to think big picture. Everything eventually makes its way stateside: the Speedo, the mullet, hot dogs, jeans, Red Bull, and yes, negative rates. And it still may be out there many, many years to come. But as we continue on this deflationary track, mortgage rates will eventually reach a new all-time low, very much like what we experienced during the pandemic. And remember, Gary, you heard it here first. Okay, is that any other questions? No? Okay. Well, thank you again for your time. See you all again next month, and namaste.